Hello everyone, this is Professor Mihir Shah. Once again, I welcome you back to our second video lecture on the subject of international finance for your PGDFM semester 2 under University of Mumbai. This video contains the second part of the first module. So let us see what all things we need to go through under our second video. According to the first module, the following were the learning outcomes. Number 1, we were supposed to learn about international monetary system that we have already learned in the first video lecture. Thereafter, we learned about the evolution of the international monetary system. Under the evolution, we learned about gold standards. Then we learned about the transition from gold standard to Bretton Woods system. And then we learned about how it got collapsed. And then we had a few animated clips to have a glimpse over the entire evolution. After that, we also learned about various types of exchange rate system which is prevailing in the current era. So the first 4 topics were already covered in the first video lecture that we had undertaken. Now in the second part of the first module, and in this current video, we are going to learn about the differences between fixed and flexible exchange rate system, the European monetary system, and lastly the difference between FERA and FEMA. Along with that, I'll be giving you all few important questions which you all need to consider and which you all need to prepare for your external examination. And at the end of this video, we will be again taking up our MCQ exercise where we'll be covering a few more MCQs from this video as well from the previous video. So let us start with the second part of the first module. Let us see what all topics we need to cover in this video. The first topic that we need to cover under the second part of the first module is the difference between fixed exchange rate system and flexible exchange rate system. So let us see what is the difference between the two exchange rate system.
Okay, so now the next thing that we need to go through is the difference between fixed and flexible exchange rate. So we'll go through one by one. So the very first point under fixed exchange rate system is that fixed exchange refers to a rate which the government sets and maintains at the same level. So this is already that we have been through earlier. Key fixed exchange rate is set by the government and it maintains at the same level. On the other side, flexible exchange rate is the rate that varies according to the market forces. So it changes, it is not fixed, it changes according to the market forces. Next, the fixed exchange rate system is determined by the government or the central bank, whereas the flexible exchange rate system is determined by demand and supply forces. Fixed exchange rate system is periodically adjusted by the government. The government intervenes on regular basis, whereas under flexible exchange rate system, the exchange rate adjusts automatically to the changes in the market forces. So demand and supply fluctuates again and automatically adjust the changes. Next, under fixed exchange rate, a fixed exchange rate has a devaluation and evaluation in a currency. So the fixed exchange rate system creates devaluation and evaluation of a currency, whereas under flexible exchange rate, a flexible exchange rate can depreciate and appreciate the value of a currency. So it can either appreciate or depreciate. Next, government needs to keep huge amount of reserve to maintain the exchange rate at the desired level under fixed exchange rate system, because we've already learned earlier कि if the government want to intervene, it will require to maintain a huge amount of foreign exchange reserve. However, under flexible exchange rate, government does not intervene and it does not require any exchange rate reserves as well. Next, the exchange rate are fixed and stable, but may lead to market distortion in the long run. So in the long run, it is very difficult to have a fixed and a stable exchange rate. However, exchange rate fluctuates but remains stable around the equilibrium in the long run. So in flexible exchange rate, in the long run, though it fluctuates and is volatile, but in the long run, it becomes stable and in equilibrium. Next, there is no hedging risk if the country is using fixed exchange rate. However, hedging is used to reduce the currency risk in the flexible exchange rate. And last, a fixed exchange rate has a devaluation and an evaluation in a currency. However, in flexible exchange rate, it can depreciate and appreciate the value of the currency. So with this, we complete the modern exchange rate system available since 1973. It started off with fixed exchange rate, then we went through flexible, then we went to manage, then we saw various systems and arrangement, and lastly we saw the difference between fixed and flexible exchange rate.
Okay, the next topic that we need to go through is the euro currency market. Now, the euro currency market is the legal market for currency outside of the country where it is a legal tender. The euro currency market is utilized by banks, multinational corporations, mutual funds, and hedge funds. The term euro currency is a generalization of euro dollar, and it should not be confused with the EU currency, the euro. So it is completely different term from euro and euro dollar. The euro currency market functions in many financial centers around the world, not just euro. So euro currency basically not a currency of the European nation, but it is, or it can be operated all around the world. So euro currency market can offer better rates for both the borrowers and lenders, but they also have higher risk. Now let us understand the euro currency market. The euro currency market originated in the aftermath of World War II, when the Marshall Plan to rebuild Europe sent a flood of dollars overseas. The market developed first in London, as bank needed a market for dollars deposit outside the United States. Dollars held outside the United States are called euro dollars, even if they are held in market outside Europe, such as Singapore or the Cayman Islands. There is not necessarily any connection between euro currency market and Europe today, although these both markets begin in Europe. The euro currency market has expanded to include other currencies such as Japanese yen and the British pound whenever they trade outside of their home market. However, the euro dollar market remains the largest. Now, the interest rate paid on these deposits in the euro currency market are typically higher than those in the domestic market. So, in a glimpse, euro currency is basically, a market which is not operated in the home country, but it can be operated in other countries. Okay, euro currency and Europe or euro are not same. Euro currency is another name given to euro dollars. Okay. And euro currency market does not only include euro or dollars, but it also includes Japanese yen, British pound, and the rate of interest paid on the deposit of euro currency is quite higher than those in the domestic market. Okay. Now we'll go through the characteristics of euro currency markets. Number one, unregulated market. Euro currency market is a market across border. Hence, the government does not have full control over the transactions. Hence, transacting entities escape from most of the stringent provisions and regulations. Under euro currency, government interference is minimal. Thus, it is an unregulated market. Second characteristic is that it is a long-term loan and short-term deposit. Euro currency loans are for longer period of time. However, the deposits in euro currency markets are primarily for short-term. This leads to asset liability duration mismatch problem for the bank. So in euro currency, the loans are basically for a longer period of time, but the deposits are for shorter period of time. So this can create a mismatch problem for the bank. The third feature is massive wholesale market. Transactions in euro currency markets are huge. They are mostly within governments and banks, public sector organization and large MNCs. This makes the market a wholesale rather than a retail market. The next characteristic is time deposit. Euro currency market exists for savings and fixed deposit and recurring deposit in banks. There is hardly any space in euro market for demand deposit. So there's basically saving, fixed deposit and only recurring deposits in bank. And last, euro dollar and LIBOR based market. The euro currency interest rates are based on a variable rate base such as the LIBOR, that is London Interbank Offer Rate. Under this interest rate, risk is reduced. This market is largely dominated by the US dollar over other currencies. Okay, the next thing that we need to go through is the components of euro currency markets. Now, the composition of euro currency markets or the components of euro currency market is broken apart in three areas, which is number one, market participants, second, euro financial instruments, and third, the transactional structure. Now, number one, as we said, was the first component of euro currency market is market participants. So who all are the participants of euro currency market? Number one, the commercial banks. The institutional core of the market is formed by the commercial banks. Banks enter the euro currency market both as lenders and as depositors. Around 20% of the world's largest bank play a vital role in the euro market. The second participant in euro currency market are the corporates. Euro currencies are mainly borrowed by corporations whose name, size and good standing enables banks to make loan to them with little more than a superficial analysis of credit worthiness. The third market participants are the governments and the central bank. The central banks and the governments are also the lenders in the euro currency markets. In addition, international institutions such as the World Bank and other regional development banks and institutions associated with the EU have been borrowers on regular basis. In the last decade, the market has also seen an enlargement in government and government related borrowers. And the last participant are the private individual. Minor participants in the euro dollar market are known as private individual. High net worth individuals are no doubtedly being significant participant as investors in the eurobond market, where the fact that payment of interest is without deduction of tax and securities are bearer securities, which gives the market autonomy and most probable attractiveness from a tax point of view. So these are the four participants of euro currency market: the commercial banks, the corporates, the government and central banks, and lastly the private individuals. Next that we need to go through is the euro financial instruments. Now, what are the instruments in euro currency market? So the number one is euro deposits. Most deposits in euro currency markets are fixed deposit at most deposit in the euro currency markets are fixed deposit at fixed interest rate whose maturity is of a short period. Around 3/4 of deposits in London euro banks have maturity of less than 3 months. So it is a very short term period. Many of these deposits are on call, that is, thus they can be withdrawn without notice. These types of time deposits are mostly made by other banks, but many are made by governments and their central banks as well as multinational corporations. The second instruments which you need to go through is the euro loan. Many euro dollar loans are direct on the basis of formal lines of credit. However, the techniques of loan syndication has been developed for larger currency by the market. Okay, the next financial instrument that we need to go through is the euro bonds. The euro bonds are international bonds denominated in a currency which is different from that of the country in which they were issued. Eurobonds are securities which are easily transferable, and the Eurobond market is a vital factor in the international finance, as the size of Eurobond market in the international market exceeds that of the US bond market. So this Eurobond play a very important role in euro currency market. And lastly, other instruments which come under euro currency markets are the other euro financial instrument consists of euro certificates of deposits, euro commercial papers, etc. The third component of euro currency market comes the transactional structure of euro market. Now, the euro currency market is completely a wholesale market. This we have already read before. Transactions made are very rarely to be for less than $1 million, while at times they are for $100 million and more. So it is a wholesale and a huge amount is negotiated in euro market. Like the foreign exchange market, the vast bulk is operated to interbank operations. The market is liked by telephone or telecommunication and is focused upon London, which has a share of around 1/3 of the euro currency market. All the euro currency transactions are unsecured credits in nature, hence the lender pays a lot of attention to the borrower's status and name. So it is not given to anyone. The person who has financially strong, has very good goodwill, only to those the money is usually lent. So these were the components, these were the three components of euro currency market. Okay, next come what are the functions of euro currency markets. So number one, euro currency market is a cheap source of working capital. Why? Lesser interest rate is attracted by euro currency loans than the loans of the domestic economy. This is due to low overheads costs. So since the interest rates are less, since the operating or since the overhead cost is less, it becomes a cheap source of working capital. So you can easily get the loan, and it will be also at a very low rate of interest. Second function is liquidity. Financial institutions find it highly profitable to hold their idle resources in euro market. Moreover, due to fewer restriction in the market, investor can make investment in better security. So there is no security required, you can directly invest in it. With the absence of tax withholding on interest, there is an advantage in this form, and on an average 80% of these deposits have maturity of 6 months. So it is a very short term loan, short term investment period. So people usually like to invest in these markets. Third, we have facilitates international trade. The euro currency market makes easy availability of loans, which helps in smoother working of international trade. Now this is mainly for two reasons. Number one, lower interest rate, and second, easy procedural formalities. Now the next topic that we need to go under euro currency market is the euro banking, or it is also known as offshore banking. Now what is this all about? A euro bank is a financial institution that accepts deposits and make loans in foreign currencies. It is not necessary for a euro bank to be located in Europe. It can in fact be located anywhere in the world. For example, an American bank located in New York, which holds deposits and issues loan in Japanese yen, would be considered as a euro bank. The euro banking offers many vital advantages to the stakeholders. Depositors try to evade from the tax net of their own country of domicile. Borrowers get liquid money for capital investment as well for working capital at a highly competitive interest rate. Now, what are the advantages of offshore banking? Number one, access to politically and economically stable jurisdiction. Offshore banks provide easy access to politically and economically stable jurisdictions. This may turn advantageous for those residing in a political turmoil areas where there is risk and fear of getting their assets frozen, seized, or disappear. So, a country where there are a lot of problems, a lot of political issues, people from there can opt for offshore banking in places where it is stable. Countries in which the political scenario is stable, people can opt for offshore banking in that case. Second, higher interest on deposits. Some offshore banks may operate with a lower cost and greater interest rate rather than the official rate in the home country due to lower overheads and a lack of intervention by the government. Next we have is evasion of tax. Usually interest is by offshore banks without deducting tax. So this is a very important advantage to individuals who like to evade the payment of tax on worldwide income. Next, non-conventional facilities. Some offshore banks offer banking services which are non-available from domestic banks, such as the anonymous bank account. So few facilities which are only given to offshore banking, which will not be available in the domestic bank, are available to the euro banks. Lastly, other advantage of the banks are that in most offshore banking centers, banks get exemption from the reserve requirement. Entry is easy to establish a branch. In most offshore bank centers, bank get exemption from the reserve requirements. Entry is very easy to establish a bank. Entry is easy to establish a branch. License fees are lower, etc. Now, with the advantages, there are also disadvantages of offshore banking. One of them is the crime and illegal activities. Offshore banking has been associated with the crime economy and organized crime through money laundering. Uh, this is a disadvantage. This is a disadvantage of offshore banking. Money laundering creates a lot of issues. Second, tax loss to the government. Tax evasion is being promoted by offshore banking by giving tax evaders with an attractive place to deposit their hidden income. So basically, it's nothing. You can also term it as black money, encouragement of black money. Third, capital outflow and volatility. Developing countries may suffer due to the speed at which money can be transferred in and out of their economy. And last, it widens the rich and poor gap. Offshore banking is usually more accessible to those on high income because of the cost of establishing and maintaining offshore accounts. Here, the middle income group suffers the most on account of the tax burden in developed countries. Now, the next topic that we need to learn is the difference between FERA and FEMA, where FERA stands for Foreign Exchange Regulation Act and FEMA stands for Foreign Exchange Management Act. So let us see what is the difference between FERA and FEMA.
But before starting that particular topic, we'll first try building up a scenario about why did these two terms came about and what they are. Okay. So let us take an example. Let's consider that you want to invest. You as an investor, we'll consider like, let's say you are an investor and you want to invest. So let's say when you have got money from foreign and you want to invest it in our country, the very first thing that you will be asked will be from which sources have you got the money from. Okay, and who will be asking this will be the regulatory body. Let's say the regulatory body that governs all of foreign exchanges is SEBI. It will ask you the sources from where you have got this money to invest, and by doing this, basically SEBI wants to know whether the money has come through hawala or through money laundering. Now let us explain what do you mean by hawala and what do you mean by money lending. So hawala is basically, now let us understand what is hawala. Now let us take an example. We'll take Mr. X, a very named singer. He performed in India and he earned a substantial amount of money. Now, as per the rule, he is supposed to be paying tax in India for earning that money in India. However, what he does is that he catches one agent and tells him he wants that amount to be transferred to his country without informing any legal authority. And why does he do this? In order to save tax. So as I wrote, as per this example, let's say we had taken Mr. X, a singer who's not residing in India. Okay, he comes to India, he sings, he earns money, so he has to pay tax in India. However, he does not pay the tax. Okay, he catches an agent, he tells him he wants to transfer his amount to his country but without informing any legal authority. He does that to save tax. So that is the basic meaning of hawala. Now when we talk about money laundering, it's actually turning black money into white. A simple meaning is turning black money into white. So if you take an example, let's say Mr. X from India, okay, he had a lot of black money. He went outside India, got an agent and told him to invest in India the amount he gave him, thereby making black money into white. So again, money laundering in simple term was nothing but turning black money into white. So let's say Mr. X, who has a lot of black money in India, runs out of India, catches an agent abroad, tells him, okay, this is my amount, go into India and invest in bits and parts and make it white. So this was the reason why SEBI usually checks in the sources from where you have got the money if you want to invest in India, any foreign currency. Now in 1973, okay, in 1973, many cases jumped which were related to money laundering. Now, to stop that, FERA was introduced. Okay, so now because of increase in money laundering in the year 1973, the government opted to introduce a new act called as FERA. So first we'll note down the full form of FERA. So that is nothing but FERA stands for Foreign Exchange Regulation Act. It was passed in the year 1974, but it was regulated from 1st Jan 1994. Now, one may ask, what was the main purpose of getting this act? So, we'll note down as the prime objective of bringing FERA into existence was preserving the foreign exchange, that is forex transaction were severely controlled by the government. So the main objectives of FERA was preserving and conserving the foreign exchange of the country, and secondly, heavily or severely controlling the foreign transaction. Now, the provision of FERA resulted in few provisions of FERA resulted in some problems. One of them was it resulted in declining the growth of forex. This created downward forex growth. Thus, after 1991, that is after economic reforms, that is in the form of LPG system, there was a need to bring a liberal law. So FERA had very severely controlled rule, so which resulted in declining the growth of forex, and it created a downward trend. So that's why after 1991, under economic reform, when LPG system arrived, there really came a problem whereby they needed to find another way, and or there was a need to bring much more liberal law. So FERA was repealed and FEMA came into existence. Now, what is FEMA? FEMA basically stands for Foreign Exchange Management Act. Again, this was passed in the year 1999 and came into regulation. So it was regulated on 1st June 2000. Now, the prime objectives were completely different from that of FERA. FERA was much more controlled and much more severe. However, in order to make a liberal law, the objectives of FEMA were quite different. Number one objective of FEMA was to promote growth in forex and maintain healthy forex reserve. Second, to facilitate foreign exchange transaction, import and export. So the first two the two main objectives, the two prime objectives of FEMA was, number one, to promote growth in forex and maintain healthy forex reserve, and along with that, to facilitate foreign exchange transactions, imports and export. So it did not only took care of forex but also facilitated foreign exchange. under this act, RBI acts as a watchdog. Now, if it's acting as a watchdog for whom? For persons who hold properties abroad and who makes payment to foreign countries. So this is a very important, one of the important objectives. Okay, under this act, RBI act as a watchdog for the person who hold property abroad and who makes payment to foreign countries. And lastly, the last objective of FEMA was to empower enforcement directorate, that is a new law in the name of PMLA 2002 was brought to catch money lenders and prevent money laundering. So to it now, PMLA, it stands for basically Prevention of Money Laundering Act. So FEMA not only, FEMA not only promote the growth of forex but also facilitate foreign exchange transaction and thereby also prevents money laundering. So these were the basic differences between the two acts. FERA was basically much more severe. FEMA was a bit more liberal. To understand this much better, we will bring about a distinguish between FERA and FEMA. Okay, on one side we'll have FERA, on the other side we will have FEMA. Now, so the very first difference in the FERA. Now, what is FERA? FERA, as we learned earlier, the main objective of FERA was to conserve the foreign exchange reserve whereas for FEMA it was to promote orderly development and maintenance of foreign exchange market. So one was to conserve, the other one was believing to maintain. Second, FERA, the other objective of FERA was to control foreign exchange transactions, whereas for FEMA it was all about to manage foreign exchange transaction. The third difference between both of them is FERA Act was quite a bit bulky. So we noted that it was bulky, that is, it was made up of 81 sections, whereas FEMA was a bit shorter. Okay, it was so we can write it. It is short and precise. That is, it has only 49 sections. The next difference was that FERA made government official more powerful. It made government official more powerful, whereas in FEMA the officials' power was curtailed significantly. The next difference was breaching of this particular law was a criminal offense. So if you were caught under FERA, you were imprisoned. However, in FEMA, breaching of this particular law was a civil offense. Under FERA, no compounding could be there, whereas in FEMA, compounding was allowed. Now, the term compounding stands for payment of money. So in FERA, if you were caught, you were charged with criminal offense, you couldn't get away by paying a penalty. So in FERA, there was compulsory imprisonment. However, in FEMA, compounding was allowed. So if you don't want to be imprisoned, you could pay a penalty and get out of your issues. The next difference was when FERA and FEMA came, the term which was basically considered was your residential status. Who will be charged with FERA and FEMA? So how will your residential status be decided? So under FERA, only citizenship was the criteria. Okay. So if you were a citizen of India, you would be given your residential status. However, in FEMA, any person who is residing for more than 6 months will have the residential status. So these were the various differences between FERA and FEMA. Prior to this, we learned why FERA came into existence, what was FERA, what were the main objectives of FERA, and FERA couldn't stay for long. So how did FEMA came into existence, and then what were the objectives of FEMA. And then lastly we did the difference between the FERA and FEMA. So with this we can conclude the topic based on FERA and FEMA.
Okay, now that sums up the part 2 of the first module. Now before putting an end to this video lecture, we will have one more exercise based on MCQs. So let us see which questions are available under the MCQ exercise. Number 1, FERA was passed in the year dash. Second, FEMA was passed in the year dash. Third, FERA was a long enactment with dash number of sections. Now read the question once carefully. Try figuring out what might be the right answer for it. I will give you a couple of minutes to solve it and then we will discuss the answer. Discuss the answer. Number 1, FERA was passed in the year. The correct answer for this is 1973. And second, FEMA was passed in the year dash. Now 4 option 1989, 98, 73 and 99. The correct answer for this is 1999. And the third one, FERA was a long enactment with dash number of section. The correct answer for this is 81. Now let us see the next set of MCQs. MCQ number 4 states that FERA was a small enactment with dash number of sections. Dash is determined by government or central bank, and dash is a rate that varied according to the market forces. Again, read the question carefully. Okay, figure out what might be the correct answer, and then we will discuss the answer. I'll give you 3 minutes to solve it, and then we will discuss the answers.
Okay, with this we come to the end of module 1. This is the question bank of module 1. So from the exam point of view, you all have to prepare yourself based on these question bank for module 1. For further queries, if you have on module 1 or any other queries related to module 1 or international finance, you all can email me at mihir.shah010@gmail.com, or you all can drop in a message on WhatsApp, the contact number for which is provided. Thank you.
Okay, let us discuss the answers. For the fourth one, FERA was a small enactment with dash number of section. The correct answer for this is 49. Dash is determined by government or central bank. Central bank and government, they decide the fixed exchange rate. Dash is the rate that varied according to the market forces. The market forces is based on flexible exchange rate. I hope everyone must have got the answers right. We'll move to the last set of MCQs. Again, 3 MCQs are given, under which the first one states dash made responsible for monitoring and managing exchange rate between currencies. Second is dash was made responsible for financing individual development projects. And third is the period of interwar period. Again, I'll give you a couple of minutes, read the question correctly, figure out what might be the correct answer, and then we'll discuss the answers. Okay, let us discuss the answers. Number 1, Dash was made responsible for monitoring and managing exchange rate between currency. It was the IMF. The second one, Dash was made responsible for financing individual development projects. The options are IMF, World Bank, RBI and SBI. The correct answer is the World Bank. He is made responsible for financing individual development project. And the last one, the period of interwar period is, the options were 1973 till present, 1945 to 1972, 1915 to 44 and 1875 to 1914. The correct answer is 1915 to 1944. So these were again few MCQ exercises that we had done based on the first module.
Okay, with this we come to the end of module 1. This is the question bank of module 1. So from the exam point of view, you all have to prepare yourself based on these question bank for module 1. For further queries, if you have on module 1 or any other queries related to module 1 or international finance, you all can email me at mihir.shah010@gmail.com, or you all can drop in a message on WhatsApp, the contact number for which is provided. Thank you.